On a quiet Tuesday morning, nothing looks wrong. Banks open, apps load, ATMs work. And yet, somewhere in the system, a problem the size of a paper cut has just been given permission to become a global wound. Here's the uncomfortable truth. Most financial crises don't start with greed, corruption, or villains. They start with a rule that sounds responsible, a rule designed to make banking safer, and then does the opposite. This matters right now because the global financial system is more connected, faster, and more fragile than at any point in history. Money moves at the speed of panic, and panic doesn't need a big reason anymore. Let me show you this simple trick. Imagine a small bank, not famous, not reckless, just boring. It takes deposits, it gives loans, it holds government bonds. Everything looks fine. But banks don't keep your money in a vault. They can't. They invest it, slowly, carefully, usually in things labeled safe. Here's where the trick begins. Banks are required to mark many of their assets at current market prices, not what they paid, not what they'll get back later, but today's price, right now. Most of the time, this rule feels invisible until prices move. Let's say interest rates rise. Suddenly, old bonds are less attractive. Their market price falls. On paper, the bank just lost money. Not because anything actually defaulted, not because anyone missed a payment, just because prices changed. Still manageable, so far. But now comes the second part of the trick. Regulations say if your assets fall enough, you must raise capital, meaning sell something. Fast. So the bank sells bonds. Selling pushes prices down further, which lowers asset values for other banks holding the same bonds. Now those banks look weaker too, on paper. Investors notice, ratings agencies notice, headlines notice, and depositors? They don't read balance.